welcome to the Retirement Wealth Podcast. We're so glad you're joining us today.
Absolutely. We're diving into an exciting topic that's really relevant for anyone looking to boost their retirement income.
Right. We're talking about how to generate passive income from real estate. I mean, who wouldn't want that extra cash flow in retirement, right?
Exactly. Real estate can be a powerful tool for creating that passive income, but it's important to understand the ins and outs before jumping in.
Definitely. We'll cover some key strategies like rental properties, real estate investment trusts, and even crowdfunding options.
And don't forget about the importance of location and market research. Those factors can really impact your investment success.
Yes, plus we'll discuss some common pitfalls to avoid and how to align your real estate investments with your overall retirement plan.
It's all about finding the right balance and ensuring your investments are working for you, not the other way around.
Exactly. So whether you're just starting to think about retirement or you're already in it, there's something here for everyone.
Let's jump right in and start exploring how real estate can work for you in retirement. You know, Emily, when we talk about generating passive income from real estate, it's really important to highlight why it matters right now, especially for those who are nearing retirement or have already retired.
Absolutely, David. With everything going on in the economy, it can definitely feel overwhelming. What do you think is the biggest concern for retirees right now?
Well, inflation is a huge factor. Many people remember the days when their retirement savings felt stable, but inflation has really changed the landscape. For example, I had a client, let's call her Linda, who's been planning her retirement for years. When she first started saving, her goal was to have a certain amount to last her through her retirement, but with rising prices, that same amount doesn't stretch as far anymore.
Right. And I think a lot of folks underestimate just how much inflation can eat away at their purchasing power over time. So real estate can be an effective hedge against that, right?
Exactly. Real estate tends to appreciate over time, and rental income can increase with inflation as well. Linda ended up investing in a small rental property, and now that income is helping her keep up with her expenses. It's a great way to create a buffer against rising costs.
That's a smart move. And it also addresses another concern: market volatility. A lot of people are nervous about the stock market and what it means for their retirement savings.
Absolutely. The stock market can be unpredictable, and many retirees can't afford to take significant risks with their savings. I remember a couple, Tom and Sarah, who were heavily invested in stocks. After experiencing a significant market downturn, they realized their retirement plans were at risk. They started looking for more stable income sources.
So that led them to explore real estate.
Yes! They decided to invest in a multi-family home. Now, not only do they have a steady rental income, but they also have an asset that's likely to appreciate over time. It provides them with a sense of security that the stock market just doesn't offer right now.
That makes perfect sense. And beyond just stability, there's also the tax efficiency aspect to consider, right?
Exactly. Real estate can offer some tax advantages that many retirees aren't aware of. For instance, rental income is often taxed at a lower rate than ordinary income, and there are also deductions for expenses related to property management, maintenance, and depreciation, which can make a significant difference in your overall tax liability.
Wow, that's a great point. So not only are they creating passive income, but they're also potentially reducing their tax burden.
Right! And we can't overlook Social Security changes either. Many people are concerned about the future of Social Security and how it will fit into their retirement plans. With the potential for benefits to decrease, diversifying income sources becomes crucial.
That's so true. If someone is relying solely on Social Security, they might find themselves in a tough spot down the line. Adding rental income can bridge that gap.
Exactly. Plus, healthcare costs are another major concern. They're rising at an alarming rate, and many retirees underestimate how much they'll actually need. Having that additional income from real estate can help cover those unexpected medical expenses.
Right. And it's not just about the numbers. There's also an emotional aspect to consider. Financial security can provide peace of mind, allowing retirees to enjoy their golden years without constant worry.
Absolutely. I had another client, Nancy, who was really anxious about her financial situation. She invested in real estate, and it completely changed her outlook. Now she feels more secure and liberated to pursue the things she loves. like traveling and spending time with her grandkids.
That's such a heartwarming story. It really emphasizes how financial security can lead to a more fulfilling life. And it sounds like the current economic trends are pushing more people to think outside the box when it comes to retirement planning.
Yes, with the rising cost of living, fluctuating job markets, and uncertainties in the financial landscape, people are recognizing that relying on traditional retirement strategies alone might not be enough. They're looking for ways to take control of their financial futures and create multiple streams of income.
And that's where passive income from real estate comes into play. It can be a game changer for so many people, especially when they start thinking about legacy planning too.
Exactly, Emily. Real estate can not only provide income during retirement, but can also be passed down to future generations. It's a way to create a lasting legacy, something tangible that your children or grandchildren can benefit from.
And that's a beautiful thought, leaving behind more than just financial resources, but also a sense of security for the family.
Precisely. So when we look at the landscape of retirement planning, it's clear that generating passive income from real estate isn't just a nice to have. It's becoming a necessity for many people looking to secure their financial future.
Well, I think that leads us perfectly into discussing some core strategies for how to actually make this happen. What do you think, David?
So, Emily, when we talk about generating passive income from real estate, one of the core strategies is to really understand the different types of real estate investments available, right?
Absolutely, David. I mean, there are so many options out there, like residential properties, commercial real estate, and even real estate investment trusts, or REITs.
Exactly. And each of these has its own benefits and challenges. For instance, if you're looking at residential properties, you might think about long-term rentals or even vacation rentals.
Right. Vacation rentals can be really appealing, especially in popular tourist areas. But they also come with more management needs, like cleaning and maintenance between guests.
That's a good point. On the other hand, long-term rentals tend to provide more stability in terms of income. Once you find a good tenant, it can be a more hands-off approach for a while.
Yeah, and that's where having a solid property management strategy comes into play. It's important to factor in those management fees when calculating your potential returns.
Definitely. And one thing that often gets overlooked is the tax benefits associated with real estate. For example, depreciation can provide some significant tax advantages.
Oh, for sure. Real estate investors can deduct depreciation from their taxable income, which can help reduce their overall tax liability.
Right, and speaking of taxes, let's not forget about the 1031 exchange. This allows investors to defer capital gains taxes when selling a property, as long as they reinvest the proceeds into a similar property.
Oh, that's such a powerful tool for real estate investors. It's like a way to leverage your gains without immediately losing money to taxes.
Exactly. Now, when we're discussing passive income, it's also crucial to consider your asset allocation. A well-diversified investment portfolio can help mitigate risks.
So true. For instance, a common rule of thumb is the 70-30 portfolio, where you might have 70% in stocks and 30% in bonds. This can provide a balance between growth and stability.
Yes, and adding real estate into that mix can offer even more diversification. The idea is to have assets that don't move in tandem, so when one is down, another might be up.
And that's where real estate can shine. Historically, real estate has been less volatile than stocks, which is a huge plus for retirees looking for stability.
Right, and let's not forget about tax-advantaged accounts like 401ks or IRAs. The money you put into these accounts can grow tax-free or tax-deferred, depending on the type of account.
And then there's the Roth IRA, where you pay taxes up front, but all qualified withdrawals in retirement are tax-free. That can be a great strategy for younger investors who expect to be in a higher tax bracket later.
Exactly. It's all about planning ahead. If you can maximize these accounts, it sets you up for a much more comfortable retirement.
And as you strategize, it's essential to think about withdrawal strategies, right? The 4% rule is a popular guideline for how much you can withdraw from your retirement savings each year.
Yes, the 4% rule suggests that if you withdraw 4% of your investment portfolio annually, it should last for about 30 years. But it's not a one-size-fits-all solution.
Right, so it's important to assess your personal situation. How much you have saved, your lifestyle, and even your health can all impact the strategy.
And this is where the bucket strategy can come into play. You might set up different buckets for short-term, mid-term, and long-term needs.
Oh, I love that concept. So you might have one bucket with cash or cash equivalents for immediate needs, another for income in the next few years, and a third for growth over the long haul.
Exactly. This way, you're not forced to sell investments in a down market. You can let your long-term investments ride out the volatility.
That's so smart. And it ties back to the whole idea of being prepared for whatever life throws your way, right?
Absolutely. And it's also about understanding how Social Security fits into your overall retirement income plan. Many people overlook the optimal timing for claiming benefits.
Yes. The age at which you claim can significantly affect your benefits. Claiming early at 62 means lower monthly payments, while waiting until 70 can increase your benefits substantially.
And it's not just about maximizing your monthly check. There are strategies for spousal benefits too, and it can really make a difference in overall income.
That's a great point. Strategizing Social Security can be a key piece of the puzzle, especially for couples.
And then, considering annuities can also be a way to create guaranteed income in retirement. It's like a paycheck for life, which can provide peace of mind.
Yes, but it's important to understand the fees and the terms. Not all annuities are created equal, so doing your homework is crucial.
Right. And while all of this sounds great, there are common pitfalls to avoid when generating passive income and planning for retirement.
Definitely. It's easy to get caught up in the excitement and overlook the details that could impact your financial future.
Exactly. So let's dive into some of those pitfalls next. You know, Emily, one of the biggest pitfalls I see with retirees is the sequence of returns risk. It's that concept where if you experience market downturns early in your retirement, it can really impact the sustainability of your portfolio long term.
Right, because if you're withdrawing money during a market dip, you're not just losing value on your investments. You're also reducing the principal amount that's left to recover when the market bounces back.
Exactly. I had a client, let's call him John. He had a solid plan, but he retired right before a significant market downturn in 2008. He started withdrawing from his portfolio during that slump, and it really set him back.
That must have been tough for him. So, what happened next?
Well, he realized he had to adjust his lifestyle. He was planning to travel and enjoy retirement, but instead, he had to tighten his budget significantly. It forced him to rethink his entire approach to withdrawals.
That's such a common scenario. It sounds like timing really matters when it comes to withdrawals.
Absolutely. And another mistake I see is ignoring taxes during the withdrawal phase. Many retirees underestimate how taxes will affect their income and spending power.
Oh, for sure. They might think they can just take out a certain amount without considering how much of that will go to taxes, right?
Exactly. I had another client, Sarah, who was pulling money from her traditional IRA without factoring in the tax implications. She ended up in a higher tax bracket because of her withdrawals, which really cut into her overall income.
That's a tough lesson to learn. So what can people do to avoid that trap?
Well, it's important to have a tax strategy in place. A mix of accounts like Roth IRAs and taxable accounts can help manage tax liabilities. It's all about being strategic with withdrawals.
That makes sense. It's like a puzzle, right? You gotta fit the pieces together to see the whole picture.
Exactly. And then there's healthcare and longevity. Underestimating those factors can lead to major financial strain. I've seen retirees not budget enough for healthcare, thinking Medicare will cover everything.
But it doesn't, does it? There are so many out-of-pocket expenses that can sneak up on you.
Right. I had a couple, let's call them Tom and Lisa. They assumed their Medicare coverage would be sufficient, but they didn't account for the costs of long-term care or prescription medications. They ended up facing some tough decisions when unexpected medical expenses arose.
Wow, that must have been stressful for them. How did they cope?
They had to dip into their retirement savings more than they planned, which really impacted their lifestyle. They started cutting back on other areas just to manage those unexpected costs.
It sounds like a good idea to have a healthcare plan on top of your retirement plan. What about asset allocation? Is that another common mistake?
Yes, absolutely. A lot of people get too conservative too quickly, especially after they retire. They think they need to be super safe, but being overly conservative can limit growth potential.
I've heard that before. So it's a balancing act, right? You want to feel secure, but still have growth to keep up with inflation.
Exactly. I worked with a client named Betty. She moved almost all her assets into bonds right after retiring. While bonds are safer, they didn't keep pace with inflation, and she found herself struggling to maintain her standard of living.
That's eye-opening. So what should retirees keep in mind when it comes to asset allocation?
They should consider their time horizon and risk tolerance. A diversified portfolio can provide growth while still managing risk. It's crucial to revisit that allocation regularly, especially as life circumstances change.
And what about Social Security? I've heard people sometimes claim it too early.
Yes, that's a significant mistake. Claiming Social Security benefits early can lead to reduced monthly income, which can be a long-term hit. I had a client, Mark, who claimed at 62, thinking he needed the money immediately.
And how did that turn out for him?
Well, he didn't realize that by claiming early, he reduced his benefits for the rest of his life. When he turned 70, he saw his friends who had waited were receiving much more, and he regretted that decision.
Ouch. So it's really about understanding the long-term implications of those early decisions, isn't it?
Absolutely. It's crucial to evaluate your overall financial situation and consider waiting if possible. The longer you wait, the more you'll receive each month.
It sounds like there are so many moving parts to retirement planning. What do you think are some red flags for retirees to watch out for?
Great question. One red flag is if you're consistently dipping into your principal to cover living expenses. That's a sign your withdrawal strategy might need adjusting.
And what about if someone feels constantly stressed about money?
Yes, stress can indicate a bigger issue. It's important to address those concerns early on. Regular check-ins with a financial advisor can help clarify the situation and make necessary adjustments.
So it really pays off to stay proactive rather than reactive. What are some next steps for those who might be facing these challenges?
Well, first, they should take a holistic view of their financial situation. That means checking in on their asset allocation, withdrawal strategy, and healthcare planning. They can also consider working with a financial advisor to create a personalized plan.
And that way they can feel more secure as they navigate their retirement years, right?
Exactly. Planning for retirement is a journey, and staying informed and flexible can help them make the most of it.
I love that perspective. It really emphasizes the importance of being proactive rather than waiting for problems to arise.
Absolutely, Emily. And with the right strategies, retirees can enjoy their golden years with confidence. So let's dive into some immediate steps that anyone can take right now to start generating that passive income from real estate.
Yeah, I love that. It's all about actionable steps, right?
Exactly. First off, if you're considering investing in real estate, you might want to look into real estate investment trusts, or REITs. They're a great way to get started without having to buy properties outright. You can easily buy shares through platforms like Vanguard or Fidelity.
Right, and that's a pretty low barrier to entry. You don't need a ton of cash up front.
Absolutely. Another option is to explore crowdfunding platforms like Fundrise or Realty Mogul. These allow you to invest in real estate projects with a smaller amount of money.
And you can diversify your investments that way too, right?
Exactly. Diversification is key. Now, if you're leaning towards traditional real estate investing, it's crucial to do your homework. Start by researching your local market. Look for areas with potential growth or up-and-coming neighborhoods.
That makes sense. So visiting those neighborhoods, maybe even talking to local realtors, could be a good idea.
Yes, building those connections can really pay off. And don't forget to review your current financial situation. Use retirement calculators from places like Schwab or Fidelity to see how much you can realistically invest.
Those calculators are super handy. They can give you a clearer picture of what you're working with.
Exactly. And once you have a better understanding, set some specific goals. Determine how much passive income you want to generate and by when.
So it's like creating a roadmap for your real estate journey.
Exactly. And along with that, I recommend setting up a regular habit of reviewing your portfolio at least quarterly. This helps you stay on track and adjust your plans as needed.
Yeah, I think a lot of people underestimate how important that is.
Definitely. And running retirement projections is something you should do too. You can use tools available on ssa.gov to estimate your Social Security benefits, which is a big part of retirement planning.
That's a great tip. And what about tax implications?
Good point. Using tax software can help you understand how real estate investments will affect your tax situation. It's essential to know what deductions you may qualify for.
Right. And that could save you a lot of money in the long run.
Absolutely. And don't forget to check out financial planning apps like Mint or Personal Capital. They can help you track your expenses and investments more easily.
Those apps can really simplify things, can't they?
For sure, and if you're looking for more in-depth knowledge, I'd recommend a few books. The book on rental property investing by Brandon Turner is a solid resource, as is Rich Dad, Poor Dad by Robert Kiyosaki.
Those are classics. They really change the way people think about money and investing.
They do. Also, if you prefer podcasts, check out Bigger Pockets Podcast. They share so many success stories and practical advice for real estate investing.
That sounds like a great resource to add to the list.
And remember, it's never too late to improve your plan. Even small steps can make a difference. Start with what you're comfortable with and gradually expand.
Yeah, building that confidence is key.
Exactly. It's all about taking those small, manageable steps.
And with these tools in your pocket, you're ready to strengthen your retirement plan.
So, what we've covered today is really just the beginning of your journey into real estate passive income. Well, Emily, as we wrap up this discussion on generating passive income from real estate, I think there are a few key takeaways that really stand out.
Absolutely, David. First off, the importance of understanding your market can't be overstated, right? Knowing the neighborhood, the demand, and the rental rates can really make or break your investment.
Exactly. And then there's the significance of having a solid property management plan in place. Whether you're managing it yourself or hiring someone, that really helps ensure your investment stays profitable and well-maintained.
Yeah, and let's not forget the financial benefits. The potential tax advantages and cash flow from rental income can be really powerful when it comes to building your retirement wealth.
Right, and diversifying your investments is crucial too. Real estate can complement other assets in your portfolio, giving you a more balanced approach to retirement planning.
For sure. It's all about creating a reliable income stream that can support your lifestyle. And it's reassuring to know there are options out there.
Absolutely, Emily. Building and protecting your retirement wealth is a journey, and real estate can be a significant part of that journey if approached thoughtfully.
And speaking of journeys, we'd love to hear from our listeners. If you found today's episode helpful, please like, subscribe, and drop a comment about your biggest takeaway or any questions you might have. Sharing this with someone who's planning for or already in retirement can really help them too.
Yes, definitely. We want to create a community where everyone feels supported in their retirement planning.
And next time, we'll dive into a topic that many may not consider: Social Security benefits for divorced individuals.
It's going to be a really important discussion, so you won't want to miss it.
Until then, take care and remember, your retirement wealth is in your hands.
Thanks for joining us, everyone.
Bye for now.